Sandra retired at 66. She had done everything right. 32 years of contributions. A traditional IRA worth $410,000, a pension that paid reliably every month, and Social Security coming in at $22,000 a year. She sat down with her accountant in April of her first retirement year and expected a refund. She got a bill for $11,000 instead. The accountant pointed to a line on her form, 1040, line 6B, taxable Social Security benefits. The number was $18,700. Sandra stared at it. She said she thought Social Security was tax-free. Her accountant said most people do. He was right. Nobody warned Sandra, not the HR department on her last day, not the Social Security Administration letter she received when she enrolled, not the financial channels she had been watching for 3 years. Nobody told her the IRS had a rule written in 1983, never adjusted for inflation, that had been quietly pulling more Americans into a tax trap every single year for 4 decades. Sandra is a composite. She's not one person, she is the pattern. Her story is built from the real situations that play out in tax offices, financial planning sessions, and kitchen tables across America every single spring. The names change, the account balances vary, but the structure of the mistake, the IRA, the pension, the Social Security check, the April bill that nobody warned was coming, that part repeats with remarkable consistency. When you see Sandra in this video, you are seeing the version of this story that the data says is most likely to be yours. Today, I'm going to show you exactly what that rule is, how it works, how to calculate whether it is already hitting you, and 3 specific moves that can reduce or eliminate it completely, moves that most retirees never make because they never knew the problem existed in the first place. Before we get into the numbers, drop a comment right now. Tell me your city, the time where you are, and what the weather looks like outside your window. I read every single one, and the most common questions become future videos on this channel. Now let us get into it. Here is the exact mechanism. The IRS calculates something called your provisional income. It is not a term that appears on your paycheck. It does not come up when you enroll in Medicare. It is not explained in the welcome packet Social Security sends you. But it controls exactly how much of your Social Security check the government is allowed to tax. The formula is this. Take your adjusted gross income. Add any tax-exempt interest, yes, including the municipal bond interest that you thought was untouchable. Then add 50% of your Social Security benefits. That total is your provisional income. If you are a single filer and that number lands between $25,000 and $34,000, the IRS can tax up to 50% of your Social Security. Cross $34,000, and that ceiling rises to 85%. For married couples filing jointly, the thresholds are $32,000 and $44,000 respectively. Those thresholds were set in 1983 and 1993. They have never moved $1 since. The year the lower threshold was written, the average American home cost $80,000. Earning $25,000 a year in combined income meant you were solidly middle class. Today, $25,000 barely covers basic living expenses in most American cities. The Consumer Price Index has risen nearly 2.5 times since 1984. The National Average Wage Index tracked by the Social Security Administration has tripled. But the threshold that determines whether your Social Security benefits get taxed has not moved. According to Social Security Administration research, in 1984, fewer than 10% of Social Security recipients paid any federal income tax on their benefits. Today, that figure is above 50%. That shift happened without a single vote on a new tax law, without a single press release. The threshold stayed frozen and the economy moved around them. Why the math hits harder than you expect. Here is what makes this rule genuinely dangerous for people who do not understand it. It does not work like a normal tax bracket. In a normal bracket, each additional dollar of income gets taxed at that bracket's rate and nothing else changes. Here, each additional dollar you bring in can trigger taxation on dollars that were previously completely free. T. Rowe Price has documented this effect directly. Suppose you are in the 22% federal tax bracket. You decide to pull an extra $1,000 from your traditional IRA, maybe for home repair, maybe to cover a medical expense. You expect to pay $220 in federal tax on that withdrawal. That is 22% of $1,000. But if that $1,000 withdrawal pushes your provisional income further into the 85% zone, it does not just get taxed at 22%. It also causes $850 additional dollars of your Social Security benefits to become taxable income. $850 multiplied by 22% is an additional $187 of tax on money you thought was already settled. Your actual marginal tax rate on that $1,000 withdrawal just became 40.7%, not 22, nearly double what you expected. That is not a theoretical number. T. Rowe Price calculated it explicitly and labeled it. Researchers and tax academics have confirmed it across multiple publications. The 40.7% rate is what happens to retirees in the 22% bracket who are still inside the Social Security taxation phase-in zone. Financial planners call it the tax torpedo. You are cruising through retirement at what you believe is a 22% rate. Then one decision, one IRA withdrawal, one capital gain, one Roth conversion, detonates the provisional income formula, and your real tax rate doubles without anyone notifying you. And here is the compounding problem. This is not a one-time event. Every year your IRA grows. Every year your required minimum distributions get larger. Because RMDs are mandatory starting at age 73, and the withdrawal percentage increases with age. Every year the tax torpedo is sitting there, ready to fire again. The trap does not reset. It tightens. Most retirees think about their income sources as separate categories. The pension is one thing, the IRA withdrawals are another, Social Security is a third. Dividends from a brokerage account sit somewhere else in the mental accounting. The provisional income formula does not make those distinctions. It pulls everything into one number and measures it against thresholds that have not moved in over 40 years. The first source is traditional IRA and 401k withdrawals. Every dollar you take from a pre-tax retirement account flows directly into your adjusted gross income and directly into your provisional income. If you spent decades building a significant IRA balance, which is exactly what you were supposed to do, this can single-handedly push you past the threshold. The second source is pension income. If you worked for a government entity, a utility, a large corporation with a defined benefit plan, that pension counts as ordinary income. Combined with Social Security, many retirees cross the $34,000 single filer threshold before they withdraw a single dollar from their IRA. The third source is investment income from taxable brokerage accounts. Dividends and capital gains distributions appear on your tax return even if you never sold a single position and never touched the money. Mutual funds distribute year-end capital gains whether you requested them or not. That income counts toward provisional income. The fourth source is the one that surprises even informed retirees. Municipal bond interest. Many people hold municipal bonds specifically because the interest is federal tax-free, and it is for ordinary income tax purposes. But the provisional income formula adds it back in when calculating Social Security taxation. You structured your portfolio to minimize taxes. The IRS says your Social Security is still on the table. There are 3 specific strategies that directly reduce the amount of your Social Security that falls into the taxable zone. None of them require complicated financial products. All of them require doing something deliberate instead of letting the default rules run. The first move is Roth conversions during your gap years. The window between retirement and age 73 before required minimum distributions begin, and potentially before you claim Social Security, is the most valuable tax planning period most retirees will ever have. Your income during those years is often at its lowest point in your adult life. Your federal tax bracket is lower than it has been in decades. During that window, you can convert portions of your traditional IRA to a Roth IRA. You pay income tax on the amount you convert at today's lower rates. Every dollar you convert is a dollar that will never appear in your provisional income in future years because qualified Roth withdrawals do not count as income for Social Security taxation purposes. You are paying a smaller tax bill today to permanently shrink the torpedo that would otherwise fire every year from age 73 until you die. The right approach is to convert just enough each year to fill your current bracket without crossing into the next one. A tax advisor can calculate that number precisely. The key point is that the window closes when RMDs begin, when Social Security starts, and when income from multiple sources stacks naturally higher. Every year you wait is a year of conversions you cannot recover. The second move is qualified charitable distributions. If you are 70 and a half or older and you plan to give money to charity this year, the method you use changes everything. If you write a check from your bank account, you get a charitable deduction only if you itemize. And most retirees no longer itemize given current standard deduction levels. But if you transfer money directly from your IRA to a qualified charity, it is called a Qualified Charitable Distribution, or QCD. The 2026 annual limit is $111,000 per person. A QCD satisfies your required minimum distribution for the year. And critically, it does not show up as taxable income on your return. It never enters your adjusted gross income. It never touches your provisional income calculation. The same donation, made the same way, becomes invisible to the Social Security tax formula. If your RMD this year is $20,000 and you plan to donate $10,000 to charity anyway, routing that $10,000 as a QCD instead of a bank check saves you from counting $10,000 as income. At a 22% bracket inside the Social Security phase-in zone, that single decision is realistically worth $3,000 to $5,000 in a year. The third move is filing Form W-4V with the Social Security Administration. This is not a tax reduction strategy. It is a tax management strategy. By submitting Form W-4V, you can request that federal income tax be withheld directly from your Social Security check at one of four rates: 7%, 10%, 12, or 22. Without withholding, your Social Security arrives in full every month and the tax bill arrives the following April. Most retirees entering their first year of retirement do not make quarterly estimated tax payments because nobody told them the system no longer withholds on their behalf. The IRS charges an underpayment penalty on taxes that were not paid as earned throughout the year. For the first quarter of 2026, that rate is 7%, confirmed by IRS Revenue Ruling 2025-22. For the second quarter, it drops to 6% per IRS Revenue Ruling 2026 and 5. It is small relative to the actual tax owed, but it is an entirely avoidable cost on top of a bill that already surprised you. Form W-4V is available at ssa.gov. It takes 5 minutes to file online through your My Social Security account. It eliminates the April surprise, and it forces you to plan around your real after-tax income number rather than spending dollars that belong to the IRS. One more item that many retirees are missing this year: the One Big Beautiful Bill Act, signed into law on July 4th, 2025 as Public Law 11921, created a new $6,000 deduction specifically for taxpayers age 65 and older. It is available for tax years 2025 through 2028, and it stacks on top of the standard deduction and the existing additional standard deduction for seniors. For a married couple where both spouses qualify, the combined deduction is $12,000. It phases out for modified adjusted gross income above $75,000 for single filers and $150,000 for joint filers. It is claimed on the new Schedule 1A attached to your Form 1040. If your tax software or your preparer did not flag this deduction for you, ask specifically. If you already filed without it, you can amend your return within 3 years. This deduction does not change the provisional income formula. It does not reduce the amount of Social Security subject to taxation, but it does reduce your final taxable income, which can meaningfully lower the actual tax you owe after the torpedo has already fired. Sandra's accountant told her something after she saw that $11,000 bill. He said the rule that taxed her Social Security had been in place since before she turned 40. He said it had been expanding its reach every single year for her entire professional career. He said the only reason it surprised her was that nobody who was supposed to tell her about it ever did. That is the nature of this particular trap. It is not new legislation. It is not a recent change buried in a 1,000-page bill. It is a formula from 1983 and 1993 that has never been indexed to inflation, applied against income levels that grow every year. The 50% of Social Security recipients now paying federal tax on their benefits did not fail to plan. They were never given the information they needed to plan correctly. What you can do is run the provisional income calculation today. Take your adjusted gross income, add tax-exempt interest, add 50% of your projected Social Security benefit. If that sum is approaching $34,000 as a single filer or $44,000 as a married couple, you are either already inside the trap or moving directly toward it. If you're still in your early 60s and have not claimed Social Security yet, the Roth conversion window is open. If you are already collecting, the QCD strategy and the voluntary withholding form are available to you right now. The question in every case is the same: are you making a deliberate decision or letting the default run? The IRS does not send a letter when you cross the threshold. The Social Security Administration does not call. Nobody puts this in your retirement welcome packet. This video is that packet. If this reached you before your next RMD deadline, before your first retirement tax filing, or before April, use it. Share it with one person who just retired or is within 5 years of retiring. They will not hear this from their HR department on their last day of work. They might hear it from you. Subscribe and hit the bell if you want the next one the moment it goes live. I am John. I will see you in the next one.